This meeting is being recorded.
Good afternoon, everyone, and welcome to day 7 of the 12 days of TMC. I'm just going to let y'all filter in here for about 30 seconds, and then we will get started. So everybody was commenting on my hat. This came out of one of the Christmas boxes, and it's definitely one of my children's Christmas hats, but I love it.
You look amazing.
Thanks. I look like I'm in the snow back here, like I've been throwing snowballs or something. Anyway, well, thank you everybody for attending today. And I want to welcome today's keynote session that is sponsored by MGIC. Here representing MGIC and introducing today's speakers is Kevin Hurden, Director of Product Development at MGIC. Kevin, I'm just going to let you take it away.
Well, thanks so much, Amy, and good afternoon to everyone. We're very pleased to be a sponsor of the Mortgage Collaborative and really appreciate the work they do and the partnership. And in particular, I have some personal familiarity with setting up these types of events, not for 12 days, but it is a big workload. So congratulations on on what you've done to date. Excuse me. I just wanted to share as the founder of private mortgage insurance, MGIC is celebrating our 65th anniversary this year. And so, we've been through a few cycles in the mortgage business. And, we're really here not only to help you with fundamentals of mortgage insurance, but also, we think we can contribute in a much broader way to the industry. A couple examples of how we do that would be our training platform. We've had really positive, experience with that. We had over 5,000 registrants just for a couple specific webinars we had this year, one on the basics of ARMs and one on understanding temporary buy down. So that's an example. Another would be we just fairly recently completed a survey of loan originators, and we've had over 3,000 downloads of that from the mortgage community. So we look forward to bringing these types of resources to you in the upcoming year and to help you meet the challenges. So with that, I'd like to introduce our two panelists here today. First, Awaa Tagoe. She's the FHFA Division Deputy Director for the Division of Housing, Mission, and Goals. Previously, she was the Principal Associate Director in the Office of Capital Policy at FHFA. Her team was responsible for regulatory capital policy for the enterprises. This work included oversight of the enterprise's credit risk transfer programs, non-performing loan sale programs, Dodd-Frank Act stress tests, and financial eligibility requirements for approved mortgage insurers and mortgage sellers and mortgage servicers. So that's a lot. That's pretty amazing stuff. So and not lightweight. So prior to joining the predecessor agency of FHFA in 2003, she held positions at Bear Stearns and Houlihan Lokey. Awaa earned her bachelor's degree in electrical engineering and MBA from Stanford University. And then also Aaron D., who's a chief operating officer and founding member of Loan People. For over 20 years, Aaron has worked in the mortgage lending in a wide variety of capacities, which include underwriting, compliance, secondary marketing, LOS administration, training, and operations management. Aaron participates in industry advocacy groups and is honored to serve as the Texas MBA Board of Directors. Aaron earned her BS in Finance with University Honors from the University of Central Florida and her MBA in Finance from Nova Southeastern University. So welcome to both of you. And Aaron, I think I'm going to go ahead and turn over to you to get us started.
Awesome. Thank you so much, Kevin. Awaa, thank you so much for being here and speaking to us. We definitely appreciate it. So to kick us off, I would love to talk about the recent GSC announcements or initiatives intended to foster increased affordability by reducing the fees on certain affordable products for first-time home buyers that are at or below certain income limits and for some of the duty to serve products. What specific or measurable goals is the FHFA hoping to achieve in terms of homeownership rates, or are there meaningful statistics with these initiatives?
Thanks, Erin, and thanks, Kevin, for the introduction. Thrilled to be here. So pricing, yes, pricing has been on the forefront for us this year. I would say the backdrop to our pricing changes is, both enterprises have been building their capital significantly over the past couple of years. Certain changes were made to the senior preferred stock agreements that allow them to retain capital. And so that's been a focus for them. For us, we think of pricing as a really valuable tool to meet a number of objectives, including building capital, achieving more reasonable rates of return on that capital, but also providing deeper support for low and moderate income borrowers and just supporting sustainable, access to credit. So we started this sort of holistic review of pricing earlier this year. And, some of the measurable goals, some of the things we're focused on are, again, supporting low and moderate income borrowers, supporting borrowers in duty to serve markets, but we're also really focused on ensuring that level playing field between small and large lenders, and also building capital and paying attention to profitability and returns.
Great. I think kind of to stay on the capital piece of it. So these changes are being funded by increases in fees on cash out refinances. I know with some earlier changes to AUS risk assessment models this year, some of they've reduced the number of approvals on cash out refinances on some of the riskier borrowers. So with that, and obviously being in the interest rate environment that we're in right now, and maybe some borrowers turning to HELOCs or HE loans to try to pull cash out, does the FHFA believe they will have enough income from these fee increases on cash out refinances, or are there additional fee increases that may be on the horizon to help further support these?
So I mean, what I would say is pricing is an iterative process, this review that we're doing. And so you can read into that. I mean, I would say we started out these pricing changes in January of this year. We announced pricing increases on, second home loans and high balance loans. So certainly some of that will offset, some of the decreases that we put in place. Then, of course, as you mentioned, in October, we announced the elimination of the upfront fees for several categories of borrowers and the enterprises' affordable mortgage products. And then there were targeted increases in the upfront fees for cash out refis to offset some of it. But I do think some of the offset will also come from fee increases that were made earlier in the year. And we have not completed our review. We plan to, continue to look at the single family pricing framework for upfront fees next year.
Okay, more to come on that, I guess. I'll be looking eagerly. All right, so we're going to stay in capital, but let's flip it into the capital of your seller servicers. So recently, the capital requirements have been updated, really in the last several months. And I know you were closely involved in that process. So I would love to know some of the important considerations that FHFA used when determining these new requirements.
Sure. As you said, capital is near and dear to my heart. So the Enterprise Regulatory Capital Framework, which was initially finalized in 2020, I mean, like other regulatory capital frameworks, it has, risk-based capital requirements, it has leverage capital requirements. And the changes we made that we finalized in February of this year touch on both components, risk-based capital and leverage. The rule focused on adjusting their risk-based capital requirements for credit risk transfers, as well as the leverage buffer. So we reduced both. And the thought process behind addressing those particular items is, FHFA for several years, I can go back to 2014, has established requirements for both enterprises to transfer risk away from taxpayers to public investors, to the private markets. We think this is really important in conservatorship. It probably will be important outside of conservatorship to mitigate some of the risks posed by the size of the enterprises and the monoline, concentration in mortgages. So we think, credit risk transfer is really important. And so the changes we made were meant to sort of incentivize more of that, type of transaction, more credit risk transfers, make it more economic, because we had a capital rule where, leverage, could be binding in most instances. And we thought that was not the right, relative approach between risk-based capital and leverage. The leverage requirement, we believe, and other regulators will confirm this, is meant to serve as a backstop to risk-based capital. And so those were the adjustments we made earlier this year.
Okay. Yeah, and I think you mentioned according to other regulators that I think it's worthy of noting that FHFA collaborated with Ginnie Mae on the liquidity requirements for non-banks. And I will say, as a non-bank lender, I do appreciate it when our various regulators work together. So thank you. We definitely applaud that. Are there other plans to continue to work with Ginnie or other agencies or regulators in the future?
Absolutely. That was a great experience working with Ginnie. As you know, we came out initially with our requirements for seller services going back all the way to something like 2015. We came out requirements for Fannie and Freddie. Ginnie has their own requirements. And we heard from the industry, like, it would be good if you guys talk, right? So this time around, we paid attention to that, right? There were a few items specifically that we wanted to address, in that collaboration. We understood, that most of our requirements before the seller servicer requirements were driven by requirements for the servicing business. We hadn't focused as much on origination. This was something we wanted to fix. We also wanted to get a little bit more granular, more precise on the type of servicing on the remittance schedule. So we did some of that. It was a, fine tuning. And we also thought that it would be important to add additional requirements for the largest counterparties to the enterprises in this space, just, add some additional belts and suspenders. So we did some work independently, but then at the point when we started getting really serious about it, we talked to Ginnie and we figured out to the extent practicable where we could align, we did that. And we had multiple iterations of these conversations just to make sure that, when we were different, we were really clear why we were we were taking a different approach. And
yeah, again, it's really great, again, not to be repetitive, but it's really nice to try to have the regulators work in lockstep for us so that we can really understand the playing field that we're in. So we're going to take a flip to a new topic now. FHFA has also made equitable housing finance a major priority, something you alluded to in the original question. So you have the goal of reducing the homeownership gap for minority communities. So I would really love to hear more about these initiatives. What are you guys doing? Specific goals that you're hoping to achieve through all of the different programs that you're working on?
Sure. So, as you know, we have the statutory requirements for the enterprises on mission, things like housing goals and duty to serve. We already had this sort of process in place where we would request each enterprise to present us with a 3-year plan for how they were going to meet those targets. So with equity, we stepped back and we thought, given the backdrop, things like the home ownership gap have, not improved significantly over, many, many decades. And it isn't because people haven't tried to address these types of issues over time, but we thought it would be helpful to have a much more sort of methodical, programmatic approach, the same type of approach that we take for other types of initiatives. So I think it was in 2021, we asked the enterprises to develop these equitable housing finance plans, specifically focused on, improving equity, ensuring that all borrowers and renters, including underserved communities, have, access to safe and decent and affordable housing. And I think we think they did a great job with those plans. Particularly, we're very happy about the work they did on the barriers to housing. And also they outlined, as we asked them to, potential responses over 3 years to address, some of these issues. And they're really quite creative about some of these, about some of the plans moving forward. Clearly, we're rolling things out slowly. Some of these things are in special purpose credit programs. There's a particular initiative that we're quite excited about, which is reporting on-time rental payments to credit bureaus to help renters build credit scores, which will help them, in the future to achieve home ownership. I think that one might be in Fannie Mae's Equitable Housing Finance Plan. Clearly rental payments are probably the largest expense for most renters. And so we think it's great that on-time payment for rents will be now factored into the credit decision. So far we've seen really good take up and really good response. But there are a number of other programs, other planned initiatives, which we will report on as these initiatives are rolled out. So expect to see more from us on this.
Awesome. I love it. It's great. You're like the coming attractions today.
That's right.
All right. So, I'm in Austin, Texas, and, really up until recently, our housing market was gangbusters. It's a little different now. But really housing supply has been a major area of concern for the industry as a whole, not just the Austin or other market areas, but affordable housing specifically. The supply of affordable homes has been a massive topic and a massive thing that we've had to deal with as an industry. There was an article that came out this October by Fannie Mae, and it estimated that the shortage of housing units for sale back in 2019 was 3.8 million units short. And that obviously was prior to the pandemic, prior to all of the issues that we saw from supply chain and price appreciation and everything that came through. So I'm sure that 3.8 million is far higher now. The article does go on to state that while the problems are national, the solutions are local. So I would love to have you opine possibly on what some of these solutions could look like and how the FHFA can help from a policy standpoint in reducing the shortage of housing supply and narrowing that gap.
Sure. So I'm going to take a stab at this. I'm going to tell you upfront, I'm not an economist, so you can take whatever I say with a little bit of a grain of salt. But as I understand it, so clearly Fannie and Freddie, they operate in the secondary mortgage market, as do the Federal Home Loan Banks. So being that, our regulated entities, their ability to influence housing supply is limited, given their role in the market. That said, we understand that the limited housing supply is driven by a number of factors, including things like, tight labor supply and high construction costs and really local and municipal zoning laws, et cetera. But given all that, we're doing what we can in this space, particularly recently. The enterprises made changes to their credit policies. They now accept single-wide manufactured housing as an acceptable property type for the guarantee. So we think that is, contributing to supply. They have expanded eligibility on 2 to 4 unit properties. So that should also be helpful. And they're both exploring their existing policies on accessory dwelling units, which I know there's a lot of buzz around ADUs, but so far this is still trying to work through that, but at least they're considering it. Other initiatives we have, this is probably small right now, but on their REO, real estate on properties, they extended their first look programs from 20 to 30 days. And this allows, owner occupants, that first 30 days once an REO is listed, to purchase the property before allowing investors to express an interest. So we think, marginally that should improve supply for homeowners, for owner occupants. And then on the multifamily side, we believe the LIHTC program is a really good way of incenting, building affordable rental supply. And we increased the enterprise's cap for the investments they could make to support LIHTC from, it was $500 million each last year to $850 million each this year. So that's a really substantial increase that we think will support the multifamily supply side. So we're happy to participate, but I think on this one, it may not be kind of the mover and shaker that the enterprises typically are in this space.
Well, I think for not being an economist, that was a great answer. My friend Tony would be proud. All right, so credit scoring models, along with the changes in affordable pricing for affordable housing, you guys are also have announced looking into utilizing having changes in credit scoring models that are being utilized, allowing non-traditional credit, kind of VOR, like you mentioned. I'd love to hear more details on this and kind of what this will look like using alternative credit models and the benefits that you hope to achieve in overall homeownership goals.
Sure, and this decision was a long time coming. I think that people at the agency who've been working on it for 6 or 7 years, so it really did take us a long time to get to this, but we think we're in a good place. As you mentioned, in October, the director announced that FHFA was approving both FICO 10T and Vantage Score 4.0 to replace classic FICO, which has been used for almost 20 years. And we think, that both models bring benefits in a couple of different ways, compared to classic FICO, that they are both, more accurate and more inclusive than classic FICO. And, that they both factor in new payment histories for borrowers when available, and things such as rent and utilities and telecom payments. So we think all of that is net positive for credit. The process of implementing both scores it's going to be a multi-year process, because we know the enterprise, credit scores are used throughout the process, from, eligibility to, pricing. Clearly they're embedded in our capital framework, their disclosure implications. So we need to think through that. We're working on those implementation plans. We expect the enterprises to engage actively with, with the industry as we, move forward with that process. And so you'll definitely hear more from us on this next year.
And Kevin, I would imagine this is something y'all are highly or will be engaged in with them as well.
Yeah, thanks for mentioning that. In fact, it was a topic of conversation yesterday. So yeah, we're eager to participate in that as well.
I love it. I think it's great. It's awesome. All right. Well, last week, contrary to some lenders who thought it was in September, but last week, the new conforming loan limits were announced.
Right.
So they came in at 726,200. I think there was, I can at least speak for myself and my peer group. I think there was a lot of nervousness around the speculation that happened around this earlier this year. So we were pleased with the number. But given the slowdown that we have had, this year, especially really since June of this year, even more so, a lot of housing markets are cooling off significantly. Can you give us any insight into the conversations that you guys had at FHFA regarding, maybe not increasing to the maximum amount or not increasing at all, or any of those changes?
Yeah, no, it's really interesting. We had the conversations last year, conversations this year, right? These really steep increases in house prices. What I'd say here is FHFA calculates that conforming loan limit based on the statute, right? This is laid out in HERA, and, we have a precedent. I don't think any director has deviated from the number that comes out of that methodology specified by the statute. So, we have the conversations. You always have to think about, if you're going to do something to surprise the market, do you want to give some advance notice? How should we approach that? But, what I'd say is, like this year, just like prior years, the director decided to, stick to the statute, go straight down the middle. And so that's the number. And I imagine that, in the future, if we may have discussions, maybe start to, think about that more publicly before any sort of decisions are made on that.
Yeah, definitely. I think, last year was really the first year that I can recall people really came out early on it. And then this year it was just insane. And, it was those of us who are maybe a little more conservative were like, well, hold on now, because we can get into trouble. Okay, well, awesome. So before we go into our final question, we've talked about a ton of initiatives that y'all have going on. Is there anything that we haven't discussed that you'd like for us to hear about?
Well, I could talk about the scorecard and what we're doing for, for this year and the priorities. I would say big picture, the director has been, really clear. Overarching priorities are safety and soundness, and then the mission, access to credit, both for mortgage credit and for rental housing. And there are a few big ones that we're focused on. We talked about pricing, that's big this year. We'll continue to feature next year. It's important to us. Credit score models, we mentioned the kind of multi-year kind of implementation timeframe. So we expect to, engage on that significantly next year. The initiative I mentioned on rental payment history, reporting to credit bureaus, that's important to us. I don't know if we talked about both enterprises actually considering rental payments in their underwriting systems. And so it's two different items on rental payments. One is, reporting on-time rental payments to the credit bureaus, but the other is actually consuming them in their underwriting process. So that's really important. That should make a difference for some borrowers. So we're excited about that as well.
That's great.
Yeah.
Yeah, y'all are doing a lot of really great things. So, all right, well, going into the last question, obviously it's no secret that this has been an incredibly challenging year for us. It's my 20 years in the business, probably, some of the one of the worst years, and I was a subprime kid. So that should say something. So I'd love to know kind of what are the things that we can best focus on to ensure that coming out of this, because we will definitely come out of this, to ensure that we are strong, focused on responsible lending and ensuring that we continue to provide value to the communities that we serve.
I would say, the word we use a lot here is sustainability, right? Making that link between access to credit and safety and soundness. That, we all understand that we'd want lenders to, to support the market, to support affordable housing, Fannie and Freddie as well. But say sustainability is important. So we're starting to think about, origination and servicing together, like making that loan, but making sure that if the borrower starts, they start to wobble, that we're ready with the solutions to help them to reperform. I think it's important for everybody to think about that it's not, not just the origination decision, but what can we do to make sure that borrowers continue to perform, that these are, sustainable mortgages for those borrowers. So we're focused on all of that and a number of other things we're thinking about, clearly fintech, how to bring, fintech into that discussion to help make things more efficient. And sustainable, climate risk is on the horizon as well. We're thinking about that. It's probably early stages. And, we haven't talked about the federal home loan banks, but, we're doing a comprehensive review of the federal home loan banks system at 100, and you should hear more from that next year. But continue to look for the dialogue and that engagement with the mortgage insurers as well. We have a good dialogue there too. And, it's really good for us to get the industry feedback real time on any of these things we're considering. So we appreciate your engagement with us.
Well, great. I definitely will say we really hit I will go ahead and speak for the Mortgage Collaborative and say, we appreciate always FHFA. You guys are always so great about working with us and having real conversations like this with us. So thank you for your time today. Thank you very, very much. Amy, do we have any questions we need to address in the chat pane?
I am taking a look. I did not see any questions. Somebody commented saying we're seeing big increase in tax insurance that could create challenges for borrowers into their new home. But no additional questions. While I do my wrap up, if anybody does have any questions, now's your chance. You've got 3 minutes to pop it in the chat. Thank you, Erin. Amazing questions. Great prep. Nawaa, as always, thank you for coming back. You are a repeat Keynote, so we really do appreciate your time and your efforts and everything that you're doing to help our lender members, and our communities to get the financing that they need. And definitely not last but not least, Kevin and MGIC for sponsoring. Our partners at MGIC are longtime partners of TMC, and we really do appreciate the partnership as well as the sponsorship of this session. So the next session coming up is our Capital Markets Roundtable. So head over there. It starts at 2:35. And before you do that, go to the agenda for next week. Make sure that you add Doug Duncan, economist for Fannie Mae. We've got him as one of our keynotes. We also have Renee Rodriguez. If anybody has seen Renee speak, he is very engaging. He's going to be speaking on the narrative gap. A lot of things that we're talking about now, negativity and negatively, and how we can turn that around as an industry so that our employees and, just in general, we have a better way, a better outlook, right? Because all of us who have been in this industry for so long know that it's cyclical and know that it's not always the end of the road, but sometimes you have to hear that and figure out ways to look at the bright side. And I think that's really what we need to do in this time as well. So be sure to check out the rest of our sessions. They're all really designed by our lender members, and they're for the employees that are on the call today and the employees that have been checking out all of our other sessions. So really psyched to see that we've got over 200 people on a lot of these sessions live, and over 2,000 people, 2,300 people actually registered and attendees. So just amazing in this environment, and hoping that we're spreading some holiday cheer. With that said, Nawaa, I hope you have an amazing holiday. Same to you, Erin and Kevin, and thank you guys so much. And I hope to see you soon. Have a good one.
Bye.